Welcome to Commerce with Dr. Arpita. Today we are going to discuss about derivatives. So, what are derivatives? A derivative is a financial contract. Now think of it like a shadow. Now the value of the shadow will depend upon the object casting its shadow. So, that's what the derivative is. It's a financial contract in which the value is derived from the underlying asset, and that asset could be a commodity, a stock, okay, and it is basically used for hedging, speculation, price discovery, etc., which we are going to discuss on one by one in the later slides. I have prepared a very beautiful story for you all of a farmer for explaining this concept of derivatives. So let's go to that story. The name of our story is Wheat Farmer's Dilemma. Imagine you're a wheat farmer and you are going to harvest your wheat in 3 months and going to sell it. Now you have two options, either to go with the derivative or to go without a derivative. Now, if you are going without a derivative, there is always a risk regarding the price fluctuations in the market. Okay, you will always be exposed to that risk. But if you decide to go with a derivative, what happens? You will come in a future contract, you will decide a price, you will decide a date when to sell, how much to sell, and at how much price to the buyer. And that's how you will lock in the price and will be safe from the price fluctuations. But in the case when you are going without a derivative, you are not aware, like whether it could be that whether the price could be good or it could be bad. But here, both of you, the seller and the buyer, both are locking in the price regarding the price fluctuation risk in the market. I hope this story made clear the concept of derivatives for you all. Next, I have prepared a set of 10 most important FAQ asked on derivatives. So let's discuss it one by one. And the most important one is the types of derivatives. So we are going to discuss all the four types: futures, forwards, options, swaps, in terms of the farmer's story. Now, futures, you already understood that futures is coming into a contract between the buyer and the seller for buying or selling something at a specified date in the future and at a specific price for which you pay some margin money. Okay, that is a future, and that is particularly a standardized contract. Okay, traded on the exchange. Now, in contrast with the forwards, futures, forwards are also the same thing. The basic difference between futures and forward is forwards are traded over the counter and is not standardized, but it is a personalized and a customized one. So it is basically not regulated. Now coming to the options. So what happens that in options, the farmer will purchase a put option. So put option means basically to sell, and the call option is basically to buy. So he will purchase a put option for selling his wheat, and the buyer will purchase a call option, and they both will give a premium money to the uh, platform. Okay, they both will give the premium money, and before execution of the contract only, while they are entering, they need to mandatorily submit a premium amount for coming in the options. That's what option is. Okay, one very important concept in options is that it is not like feasible for long terms, like maybe if the contract goes till year or more than a year, then it becomes costly, because every time the buyer or the contract parties need to refresh their premium amount. Okay, so yeah, that's why it becomes more costly. Now coming to swaps. So for example, there is a company, a grain company, which requires wheat, and the farmer needs to sell its wheat. So what they both will do, they both are worried. The farmer is worried that the price may decrease, and the company is worried that the price may increase. So they both will hedge this, they both will swap their risk by coming in an agreement. Now here they don't need to pay any token amount, any margin money, or any premium amount like in futures, forwards, or options. Here they simply need to come in the contract, and when, if and when, so market moves against either the buyer or the seller, then the contract will be executed. So for example, the farmer will sell his wheat after 3 months, and the grain company will purchase the wheat after 3 months from him. So there are two scenarios of the market. So for example, the farmer is considering 1,000 rupees per quintal to sell his wheat, and the buyer also, grain company also agrees to purchase at that price. But if scenario 1 says that the price of the wheat drops to 500 per quintal, so what happens that the difference of 500 per quintal will be paid by the farmer to the grain company. And if the prices increase, okay, for example it becomes 1500 per quintal, then the farmer will pay the difference of 500 to the grain company. So that's how a swap works. There is no immediate or mandatory payments, but only you need to pay when the prices go against your terms. Okay, so that's how swap works. Now, with this, we have already covered most of the parts of derivatives. Coming to our next important question is difference between futures and forwards, which we have already discussed that futures are somewhat standardized contracts, okay, but forwards are traded over the counter and are not standardized contract. They are actually customized contracts. Next question is what are options? This also we have discussed earlier, that options, now there is a very important thing in options. What happens is either you have purchased the option or either you have entered in the option contract, but you still have the right but not the obligations. If you want, you can sell or buy the particular thing in the market in which you have come into contract, but you are not obligated to sell or buy the. Coming to the swaps, in the image you can see previously we discussed something about the currency commodity swap. Now here we are going to discuss about how we do currency swap. You see there are two companies and there are two banks. Company A is taking $1 million loans from bank A, and company B is taking equivalent to $1 million, that is a 50,000 euros loan. Currently the exchange rate is $1 is equal to 0.95 euros, somewhere around that. So yeah, so today's price is basically $1 is equal to 0.96 euros. So let's suppose the bank just actually it's an old example, that's why the price is varying here, so don't worry about that. So consider it's an equal according to that time. So what the company A will do, now company A needs euros and company B needs dollars. For example, maybe company is operating in USD but needs to pay in euros, and company B is getting a good loan in terms of euros but needs dollars. Okay, so what they both will do, company A will give the principal amount and in the terms of dollar to company B, and instead pay the interest amounts in euros, whereas company B will pay principal amount in euros to company A and instead pay interest payments in dollars. Okay, now they both will pay the interest payments to each other's banks. Like company A will pay in euros to bank B, whereas company B will pay in dollars to bank A, the interest payments. So that's how they agreed to hedge their currency risk. Now, this way, they are saved from the extra costs which could be, have been in the foreign exchange markets or currency exchange rates, and also they have saved their time. That's how swaps are done for currency. Next question is what is hedging? So hedging we've already discussed that. For eliminating or reducing that risk, what we are doing, we're entering into various types of contracts, futures, forwards, options, swaps, what not. Okay, why we are doing, just to minimize the risk or to eliminate the risk from the what we are going to face in the future due to the price fluctuations, because the price is always fluctuating. Next question is speculation. Now speculation is basically earning with the belief that the price of a particular stock will rise. So, what a speculator will do after studying, after doing all the analysis, the speculator will take risk that okay, this particular stock may rise in the future. So, what he will do, he will purchase now only, and then when the prices rise of that particular stock, he will sell it. So that's what a speculator will do. Moving on to our next, what is price discovery? So price discovery is basically the process of setting the prices with the interactions of buyers and sellers, and it could be based on many tangible and intangible factors like liquidity, market structure, or information flow. So that's basically the price discovery. What is leverage? So leverage is basically controlling a big amount of capital with a small amount of capital. Okay. So what happens in futures contract? Uh, for example, there is an oil. Okay. There is an oil contract. So 50,000 or $50,000. Now the buyer will pay 10% marginal money. So the that means 5,000. So that means he only has to pay 5,000, and he's actually the owner of $50,000. Now this can magnify profits or it can also magnify losses, because even a slight change in the prices may expose the whole amount and not only the margin money. So yeah, now that's a leverage. Coming to our next, second last question, what are the risks associated with derivatives? So basically, there are four types of risk associated with derivatives, which we have covered in this slide. There could be other types of risk. Let me know in the comment box if you know any other types of risk as well. Market risk, credit risk, liquidity risk, operational risk. Now, market risk is related to something, the fluctuations happening in the market, like it could be market structure, customers' preferences, or any other changes. So that's the market risk. Okay. And credit risk is basically the company's ability, whether it is able to pay back or not. So that is the credit risk, whether with the extended credit line, whether it is unable to pay back. That's why. Now liquidity risk is something that is happening due to mismatch between assets and liabilities, companies assets and liabilities. So, and liquidity risk basically hampers the business, makes it unable to pay immediately. So, an operational risk, last type of risk is operational risk. In this, the day to day activities of a business is hampered, and it could be due to fraud or it could be due to some kind of theft, etc., personal issues, etc. Now, with this, we come to our last questions of the derivatives FAQ, that is the members or the main participants in the derivatives market. So hedgers is are basically, we already discussed, those who come into these kinds of contract forwards, futures, options, swaps. They are basically the hedgers, coming for hedging their risk of the particular underlying asset. And speculators, we have already discussed that they are basically taking the advantage of the price fluctuations in the market, and with purchasing the with purchasing the stock uh, that could that could show a increased price in the future, and then selling it later on when the prices increase. So who are arbitrageurs? They are those people who take advantage of the price difference in the market. For example, in one market the price of the commodity is cheaper, whereas in the other market the price of the commodity is higher, so they will purchase from the cheaper market and sell it in the higher market. So that's how the arbitrageurs make profit. There are one more kind of participant, which are market makers. Now market makers are basically the associated with two terms, bid and ask. So bid is basically in which they are willing to buy their buy, and ask is basically in which they are willing to sell. Now they constantly do this process of bidding and asking, quote their prices of bidding and asking. So what they do, they bid at lower prices and they ask at higher prices. Okay. So that difference between bidding and asking is their profit. So that's how market makers make money. Now that was all about some important terms and some important questions related to the derivatives. Let's move on case studies part. First case study. So, first case study is about airline fuel hedging. So, what does airlines do? That they hedge the price of the fuel. Uh, so to protect themselves from the fluctuations in the future. So yes, that they hedge it through the entering into the futures contract with the or the options with the fuel agencies so that they can lock in their price. So, and because an airline is something that runs on daily, okay, and if it runs daily, it will be needing fuel to run on. So that's how they hedge their risk of the fuel prices fluctuations. Next study is about the currency hedging. So in currency hedging, what happens is, suppose a country is exporting its product to another country. Now, to protect itself from the foreign exchange currency, or the currency exchange risk, what the exporter will do, he will come into a future contract and lock in the price of the, this will reduce their risk to the currency risk. Case study number 3, commodity price speculation. So not only fuel is what, it's also a commodity, and or not only this, even all the other commodities like oil, gold, agricultural products, all these use future prices. See, even our wheat story was also an agricultural product. So traders can speculate on these kinds of commodities by using futures contracts or options, right, and they can profit accordingly. Case study number 4, credit derivatives. Now, bank, to manage their credit risk, will buy a credit default swap to protect itself from the risk of a borrower who could make a default or defaulting on a loan. With this, we complete our topic of derivatives from my side. But if in any part, guys, if either in the concept definitions or in the FAQs or in the case study, if you feel there is any doubts, let me know in the comment box, and so that I can make the video on it more clearly as soon as possible and make it available to you guys. So please mention in the comment box if you feel anything is missing, or if you feel there is some, we need to explain a few points in a more better or in a clear way. So yes, I will be more than happy to see your comments, to read them, and to work on them as soon as possible. Thank you so much, everyone, for this. So if you find this video useful and found any insight which is useful for you, then please like and share it and subscribe my channel for latest updates. Thank you so much, everyone. Bye bye.